Now, managing inflation and financial stability are usually distinct and often complementary goals where central banks' limited policy tools can simultaneously work to support both objectives. But these goals can come into tension at times, creating a dilemma for policymakers to decide which objective to prioritize. In recent months, such a tension arose when some regional banks in the US ran into trouble due to security losses triggered by poor risk management at these firms in the context of policymakers having raised interest rates to combat high inflation. Although today, overall, the banking system is sound and resilient, bank stresses nonetheless could emerge again. In my view, given the risks that these banks have taken on, the outlook for some regional banks largely depends on what happens to inflation. Now, if inflation falls as markets currently expect, then allowing policy rates to fall, bank balance sheet pressures would likely reduce as longer-term rates fall, which would cause asset prices to climb. However, if inflation proves more entrenched than expected, policy rates might need to go higher, which could further reduce asset prices, increasing pressure on banks. In such a scenario, policymakers could be forced to choose between aggressively fighting inflation or supporting banking stability.